Hi, and welcome back to Channel 11. I'm your host, Ken Shinoda. Today's the review of October 2025, Night of the Living Bulls, because October historically has seen some weakness in risk markets, but off to new highs on the S&P. Credit spreads doing okay here, and the market marches on. Turns out to be a pretty good year for equities. So here's the land of gains. You can see market made a new high, off a little bit off the highs, but April just seems like a long time ago, and buying the dip continues to win here. Looking at the different sectors of the S&P month to date, information technology, consumer discretionary, and growth kind of leading the charge. Real estate, financials, materials taking a little step back, but year to date, information technology, growth, communication, services, really kind of the big winners in momentum, up almost 20%. Mag 7 had that setback in April, and it's just been ripping. It's just unbelievable how these big mega cap tech companies continue to lead the way. The fervor around the AI capex spending, data centers. We'll see if it's a bubble at some point in time, but right now the market likes it. Here's the S&P versus the equal weight. Always seems like a good idea to go equal weight, but with the Mag 7 leading the charge, having those big names in your portfolio is what's helping you out these days. So you can see that the S&P index still outperforming that equal weight. Speculative fervor monitor, Bitcoin, surprisingly taking a little step back. Dogecoin also, ARK kind of going sideways, and Tesla. But I think keep an eye out on Bitcoin. If you see some more weakness there, I think that is maybe a sign that some of the froth is coming out of the market. So I keep my eye out on Bitcoin. The semiconductor index looked like it was over. It was falling apart, collapsed into April. And we said, hey, maybe this is the return of the AI trade. And it sure has been with what we've seen going on in the Mag 7 and the semiconductors. But again, this is now topping up to that April 24 high. We'll see if this is a double top or not. But I think keep your eye out on this too. Trump trades. Small caps with rates coming down finally broke up above that previous high, but they're starting to turn over. Again, I think this is one of those things to keep an eye out if this can break out or not. So watch the semiconductors, watch the small caps, and watch gold too. Gold broke down, now sitting around 4,000, one of the more speculative parts of the market. 10-year Treasury yields have come down quite a bit. That's been helping the equity markets as the Fed cut rates in October, but now some of those rate cuts coming off the table with some hawkish tone and lack of data. So I think the Fed's going to wait and see hopefully they'll get some data and the government shutdown ends. Financials also have done well, but again, it looks like they're turning over a little bit. So let's just keep our eyes out on all these things. Equity performance. Internationally, month to date, big winner Nikkei. Also year to date, big winner, up 33.8%. Some of that because of the dollar weakness. MSCI emerging, also many didn't think would do well, and it's done well. Also part of that being dollar weakness. So it's internationally been a good year too. Really, Russell lagging here in the Dow, but even the Russell's up 12%. So to be lagging and up 12, not so shabby. We're all enjoying it in our PAs right now. International equities really kind of going parabolic. Look at that Nikkei, NEM. It's quite remarkable. So just so much strength out there. At some point in time, you would think we need a pullback, but a lot of retail money keeps piling into equities, and it's been working. But when things get this happy and rosy out there, and it seems like everything is working, eventually you do get a pullback. So I'm a little bit cautious given some of these parabolic moves. Make Europe Great Again, or MEGA. You can see it worked really well going into the beginning of the year, and then took a step back as U.S. equities outperformed, and now it's making another comeback here. So we still think international equities make sense in the long run. Diversify your currency. I don't think it's sell America. A lot of that rhetoric has gone away from the market. It's more about diversify away from America and just diversify our portfolios. People are all about U.S. exceptionalism. I still think the U.S. has a lot of things going for it with the tech and the innovation, biotech. So can't sell all of America, but definitely diversification seems like a good place to be. Dollar index, we talked about, it's sold off a lot. We're bouncing at that lower end of the trading range, probably overdue for a rally. We got that rally. We're now back at around 100. I think The resistance here, if you go back to kind of September of 24, January of 23, July of 23, it gets up into that kind of 101 handle. So I think dollar will hit some resistance there. And maybe that's an entry point that's good for buying some non-dollar exposure in both fixed income and equities. Here's putting euro dollar exchange rate against the last Trump administration. Amazing how close it is. And this also kind of shows that we're overdue for a little bit of a rally, but now maybe we'll bounce off that 101 area and continue a weakening of the dollar. So let's see how this plays out. I mean, I don't love these kind of slides because you're just like putting two slides on top of each other and saying, hey, look how close they are. But it's pretty remarkable. Yen weakened again up into that kind of 150 area. Again, I think that it seems like it's going to catch some support with that dollar hitting resistance at that 101 area. So I would look for a yen rally maybe as well. Commodities finally in this upswing, a lot of it driven by obviously precious metals, but they kind of went sideways for many years after that big run up coming out of the COVID pandemic. And here, as we look, it's kind of a mixed bag. So month to date, natty gas and agriculture leading the way, livestock, silver, and crude oil underperforming, but crude oil slightly up. Year to date, really, it's all about gold, silver, and precious metals. Gold has given a decent amount back, but still up a lot year to date, 50%. Pretty amazing. When silver goes parabolic and plays catch up to gold, I always get worried. We talked about that last Channel 11, and you saw that silver go parabolic, and then now we've seen this pullback in both gold and silver. This doesn't really show you the pullback because it's so strong month and year to date, but if you looked at a total return chart, you would see that pullback. So I think could see some more weakness, consolidation in those precious metals, just given how strong they've been. Things can't go up to infinity. Here we go. ISM manufacturing is some of the only data we have. Came in weak, sub 50, services sitting there right there at 50. We're going to get some services data soon. But other than that, I had to take out all my data because we don't have data. We don't have jobs data. So we need the government to come back on. So that'll make this Channel 11 a little bit shorter. All right, Fed funds beginning of the year. Market thought we'd get to 370 by the end of next year. Now we're down at 3%. Well, this is why the equity market's so strong. This is giving hope to borrowers and floating rate debt. And, I think there is a potential that maybe we don't cut as aggressively if the economy stays strong. And we've had a decent rally in fixed income. So I'm a little neutral on bonds here, given how much we've rallied. And here you can see just how much we've rallied. The 2-year got all the way down to about 350. The 10-year got down just below 4%. And now we're pulling back a little bit here. So I could see a little bit of a sell-off, maybe 10-year up to that kind of like 425, 430 area. And so I wouldn't aggressively be adding duration just right this second. I think let the market back up a little bit. And but the fears of fiscal excess and deficit spending have seemed to be decreasing a little bit because all these countries have issues. France looking at a downgrade, and Germany's spending more money. So Japan's debt to GDP is still massive. Maybe America's not that bad, which is why you're seeing with U.S. rates higher than the rest of the world, you're seeing some actual international buyers still in the marketplace. With all the fear mongering out there, international holders of U.S. Treasuries hit a new high recently. Who would have known? Here we go. 2s10s, 2s30s had a big steepening, paring a little bit of that back. And, I still like the 2s30s conceptually as a hedge on the long end. I don't really like having that ultra long end exposure. I'd rather have duration kind of at the front to belly of the curve. But the steepener had a big run. Look at in May of 23, negative 100 basis points, now positive 100 basis points. So 200 basis points of steepening. So I think one of the reasons the Fed cut is that inflation expectations remain muted. Here you can look at break evens. They're pretty stable. And so the Fed's looking at this, and then they see the weaker jobs reports, mainly payrolls, and that's leading them to do another cut. And now they're in wait and see mode to get data. Hopefully the shutdown ends. Fixed income, month to date, everything up except levered loan triple Cs. You're starting to see some more articles, every week about some company going bad. I think BlackRock, with their purchase of HPS, had exposure to a name with fraud. You have that First Brands issue that's a lot of investors have been asking about. So I think floating rate, risky parts of the market, levered loans, the bottom of the CLO capital structure, and private credit. I think that's where some of the risk lies, and we've talked about that over the last couple of Channel 11s. So we've been decreasing some exposure there and moving into some other parts of the market that already got beat up, like CMBS. It's pricing a lot of bad things, and so that's one of our preferred parts of the market. Year to date, ag up almost 7%. Who would have thought? EM sovereigns up 13%. Rest of fixed income up anywhere between 5 and 8. The floating rate parts lagging the fixed rate parts. Over on the far left, agency MBS up 7.7%. Make mortgages great again. They suffered for much of the rate rise, but I think they're one of the more interesting places to be. Very low correlation to equities. I think about adding them to your portfolio as a diversification to equities and credit. Year to date, most spreads in the gray. A little bit of widening recently, with some shakiness in parts of the equity market earlier this month, but still solid returns. And I think fixed income is back having a place in people's portfolios, and people are feeling more comfortable with it. Spreads backed up a little bit, but still near historical tights on investment grade and high yield. So what looks cheap? Still agencies, still some of those securitized markets, but many of these sectors, these dots continue to come down as spreads continue to tighten. So absent a sell-off in the equity market, I think it's kind of a stable credit market, and it's going to be the pain trade is a grind tighter in these sectors, which is good for performance, but it makes future returns harder to come by. Anyways, this was an interesting October. We didn't get the sell-off that the market doom and gloomers were expecting. It was off to the races with stocks making new highs. Good luck out there. We'll catch you on next month's Channel 11. Thanks.